Hello, this is Jeff Bish, president of MarketGauge.com, and welcome to the latest trades and tutorials video. Now, as the title of this video suggests, I want to show you why the Brexit calamity has just given you, traders or investors, a gift that is going to keep on giving. And by the way, this is just a taste of what I am putting out in our holiday special video. It may even be more than one video by the time it's all over. So if you're not already getting the emails that are our holiday July special, make sure you go to marketgauge.com/July 2016 special. Free videos that are not the same as this, but similar. And if you like this, you're really going to like that. And also, before I get started with this video, if you're just finding us for the first time on YouTube, please subscribe to our channel. And also know you can find more videos like this at marketgauge.com/tutorials, as well as on Twitter, on two different feeds, at Market Minute and at Market Gauge. And if you're finding this on Facebook, like us and head on over to our site for all those additional videos. All right, so why am I saying that Brexit has just given traders a gift that's going to keep on giving? Well, it has to do with the fact that the markets in general are all relative. And when the markets are shocked by a news event, as we were in Brexit, right? So most of you probably already realize that this was the day before the Brexit vote. This was the day of the Brexit vote. And then this was the following day, right? So we had a market that got completely faked out. What does that mean? It means that the longs that weren't strong holders all dumped. It means that shorts who were aggressive all had a chance to really press their bets. Now, the great part about Brexit was that when this news came out, it was almost universally accepted that this was going to be an absolute terrible thing for the markets. And then the markets confirmed that with their price action. So what does that mean? What does that give you? It's a gift. It's a gift because when you have a situation in the markets where you can pinpoint price points at which the markets were filled with fear and despair, which is exactly what we had at this low, you're able to define a pain point. And that pain point is a point that's going to be a significant level going forward. So the gift that keeps on giving, if I make this really straightforward, is the fact that we are able to define the high point when the market thought Brexit wouldn't pass, and the low point when Brexit had passed, and everybody was feeling like this was the beginning of the end. Now, I realize I'm being a little dire in that description, but not entirely in terms of the way the market was reacting. All right, so what this does is it sets up an event range. So sometimes event ranges are 1 day, but really you should give them more than 1 day because, as you can see here with Brexit, if we only gave it 1 day, that would not have been true. However, it is partially true. I'm just not going to go into that level of detail of how to play event ranges. We will get some of that in the July special that I just talked about earlier. So again, this is not the same thing, but it relates. And if you saw my last video, which happened to come out on this particular day or this particular day, I talked about the fact that what we wanted to wait for after the market started to sell off, and I didn't realize it was going to turn around that day, was we wanted to wait for the market to come back up through the high of a prior day. And that would be the first sign that there might be a reversal, and then we'll look for a close, and that's the second sign. And there's a whole process that I take traders through, and I take myself through when I'm looking for reversals and key breakout points. So back to the gift. The gift is this range. Now, I'm doing this video actually during Friday, so I don't know where Friday is going to end up, but it's not going to change what I'm describing here for you. The fact is that we can define this range, and when the markets move below this range, it's going to be a really significant break lower. When the markets move above this range, it's a significant break higher. Now, in the interim, there are a lot of stocks and ETFs that are going to beat the markets through these levels, and these same levels apply. So the savvy trader is now looking at these levels to determine which stocks are particularly strong and which ones are particularly weak. Now, depending on the direction you think the market's going to go in, you're going to want to get into the strong stocks first or into the weak stocks first. Personally, the way the market's going now, I'm more interested in getting in the strong stocks first. All right, now this was true. This is true now, and it was true on these days as well. So let me just give you a few examples, and then, like I said, if you like this type of really straightforward ways of determining where the key inflection points are in the market, make sure you get to the holiday 2016 special URL to get completely different but related types of tricks to know which way the market's going to go. So let's apply this to some individual stocks and ETFs. In fact, let's go right to one of the ones that I talked about in the prior video, and that was one of the leading sectors was SMHs. And so what I said in that particular video is we wanted to see SMHs rally if the markets rally, and that it has in fact happened. So now the next layer of this is, you know, that if we get over that level, that would really be significant, right? Well, SMHs haven't gotten there. They're not the first ones there. The other one that I talked about, though, was XLV. Okay, so check out XLV. XLV has taken out that level. In fact, it took it out yesterday. So now, if you're a trader, even an investor, you have this as a really key inflection point. One that would make sense to have entered the other day. And also, don't feel like you've missed it. When I say this is a gift that keeps on giving, stocks, ETFs, sectors, countries, they're going to break out above this level. Then they're going to come back and retrace to this level. If you know how to trade around a key support or resistance level, then this is a gold mine of opportunity to identify low risk, high opportunity trades. So XLV, for example, breaking out above this level, is now in a position to be a market leader. And in fact, today, you can see this is a 5-minute chart here, has taken off. You can see yesterday, when it broke out of its opening range as well, another methodology we use, took off. All right, so this is how you can identify key levels with huge opportunities. So what are some other things that are interesting that are going on right now? Well, Twitter. Check out Twitter. Now, XLV could be interpreted perhaps as being defensive, right? Because it's healthcare. Not entirely, but it could be, but not Twitter. Right now, Twitter is taking out the day before Brexit. All right, today. This is something I'd keep an eye on. All right. Another one that is of interest, and how you could have played this during the Brexit debacle, is that this is the day after Brexit. Okay. Now that's the Friday. On Monday, look what J&J did. Right? J&J didn't go down with the rest of the market, and this is the 50-day moving average. So when I say the market is all relative, J&J was telling you right on that Monday that Brexit panic was over, and that was the key level. Now, for most of the market, it was down here. This one was even higher. So if you were looking for something to get into to buy the reversal on Monday, J&J was a perfect candidate. And in fact, Keith pointed this out. This is our real motion indicator down below here. And Keith pointed this out to members over the weekend, that J&J was ripe for a move higher because real motion was confirming the fact that it was holding the 50-day moving average and it had good relative strength. And certainly it was a easy, painless move right back up, and it has the same quality days before the rest of the market. All right, so it's not that hard to do. Now, another one that happened actually during the Brexit move altogether, KR. Now, this is a slightly different application of the same concept. So here's the day of Brexit, right? So while the rest of the market was falling apart on the 24th, that Friday, Kroger was going in the opposite direction. Now, Kroger is a defensive stock, all right, or could be conceived as a defensive stock. But as the whole market was falling apart, and I don't just do whatever CNBC says, but CNBC made a comment that Kroger was actually trading up on the day. I immediately went to the Kroger chart, saw that it was in fact not only trading up on the day, but had bounced off support. And I don't usually show people this, but on a 5-minute chart, if we take a look at our real motion indicator, which is a momentum indicator, which I won't go into all the details with right now. Again, if you go to the other links, I go into more detail. Go into the holiday special, I'll go into more detail about how this works. But essentially, if the bottom indicator, which is the real motion indicator, has its 50 period moving average, the blue, and over the 200, and then the price action, here's the 200 period moving average on the 5-minute chart, is also positive. Notice how the momentum on Kroger here was much more positive than the price action leading up to this. So all I had to see was that we were breaking over the prior day. The real motion was confirming it. It was running ahead of a market that was collapsing, and it was near a significant low. And I had a great stop, a great opportunity to get in down here. Now, I'm not in love with Kroger, but it certainly has been nice being long. I've taken out some, and we'll see where it goes. All right, so that's the type of trades that are going to set up. Now, that's the fast version. Happens kind of in real time. Now that the range has been established, you're going to be able to take those similar types of trades. Now that you know, you want to watch that Brexit high the day before the vote, the Brexit low, the Monday lows after we'll call it the hangover Monday reversal. And those levels are going to be your key levels to watch. That's how you can benchmark which stocks, ETFs, markets are strong and which ones are weak. And the strong ones should continue, the weak ones should continue on the downside. And if you're nimble, you can also play reversals around those key levels. All right, so I hope that helps. And if you liked this video and you like this concept and you'd like to have more stuff like this, make sure you go to themarketgauge.com/July 2016 special. I'm sure you're going to like it. That's all for now. I'll see you in the next video.